We have such a great AI story going on right now, but when I think about the questions that I get from clients, there is still a lot of consternation out there. I think there's fear. I mean, the tariff moment was a moment of great fear, I think, broadly for a lot of clients. And then there's still a lot of enthusiasm around alternatives like gold and crypto, and people concerned about the U.S. future. So I think people are in financially, but mentally and emotionally, there's still some hesitation and reservation there.
I mean, it's proven once again today, this is an AI marketplace, that's for sure, that the AI narrative, as it were, is still alive and well. How about diversification into fixed income? How do you try to weave that discussion into your conversation?
Yeah, I would say that after 2022, there was real hesitation on the part of financial advisors, on the part of retail investors, real concern about whether fixed income was a hedge. But what we're seeing this year from fixed income is pretty strong returns, I think, for a lot of folks. Yields are a lot better. I think, there's a lot of, I would say, commentary around is 60-40 dead, but I think it certainly has delivered in 2025. And so with all the doubts, that continue to persist around that type of basic strategy, I don't know if people can throw the towel on it at this point in time.
What's the discussion you guys have with your clients about rebalancing? In terms of you've got some real big winners, let's take a little money off the table. And
he asked this question just to upset me.
Tom.
Why is
He's
this?
not a big
I'm
fan
curious.
of the rebalancing thing.
Interesting. So here's my view on rebalancing at this particular moment. I think when we're in a AI moment like this, an innovation cycle like this one, where there is just massive enthusiasm, and maybe rightly so, around what the technology is able to do for the economy, and then those gains accrue to the AI winners at the moment, we have the potential for prices to soar past, with enthusiasm, what the fundamentals say, and then we get these bouts of volatility. And so in my mind, we should talk about rebalancing on a permanent basis, but in a moment like this one, I think it can help save some of the fits and starts for a portfolio.
But I know it's not an Empower opinion, but with all your work, particularly at Morningstar, Marta Norton, the bottom line is the key plug-in to the rebalancing theory is the how offenness of it. And
Absolutely.
I respectfully would say the street has an addiction to this because it's an excuse to get in front of clients. In the academic study, Paul, across cycles, bear markets, the whenness of it is a huge deal. Do you find it empowered that people are doing it too much? They're moving in, they're trading their 401k.
I mean, we've been playing around with some different studies on rebalancing. And if you're taking a look at like a monthly rebalance scheme and you look at what that would generate, if you're just tracking the S&P 500, you could see a turnover of less than 10% on a monthly basis, but that generates overall turnover about 100% on an annual basis. And
Lisa's
that can really
kids are doing that on the couch over at Robinhood.
So we're just confirmed once again today, this is an AI-driven marketplace. Outside of that, are you guys looking for value in other sectors, or I mean, if you do that too much, you kind of miss out on the performance.
Well, that's true. I mean, it's interesting that if you're a real skeptic on the AI theory and you move out of it completely, you're missing the bulk of the U.S. market gains, right? The U.S. no longer looks so exceptional relative to other markets. I think one thing that I listened to Jeffrey Gundlach's podcast on Odd Lots recently, and one of the things he said is, the market is expensive everywhere. And it's hard from the research that we've done, at least within equities, to disagree, because when we look at valuations, we look at it on this decile basis. We want to make sure that we're only looking at the extremes, because valuations, when they're just modestly high, they're really not predictive of returns. So we want to make sure we're really capturing those extreme moments. And when we do that sector by sector, most of them look to be at extremes.